All right, so overall, it was a good day, obviously, for the Bulls. Not really a surprise. If you think about it, daily chart. So let's look at the RTH chart. And you can see on the RTH chart that the market has formed consecutive sell climaxes. 4-bar microchannel here, pause, second leg down here. We had a second leg down here. When I say second leg, I mean we had a 4-bar microchannel here that got a symmetrical second leg, maybe a little bit more symmetrical. It's obviously not the second leg down in the sell-off. It's consecutive sell climaxes. And at some point, the odds are the wedge is going to prevail and the bulls are going to get the reversal up and test of the most recent major lower high. And so for the bears, selling down here, it's a little bit dangerous. You're selling in a location where the odds are you're probably going to find buyers and get a couple of legs sideways to up. And that's why I thought, all through here, I thought probably buyers in this general location. Why? Because the odds are pretty high. It's someone buying and just scaling in all the way down, especially if they can use a wide stop and scale in. Odds are they're going to make money. And therefore, that makes me think that bulls buying and scaling in, it's just a matter of time before they make money. Less likely the market's just going to plunge down to 6,000. That's why I don't remember where, somewhere over here. I can't remember if I talked about it at 6,600 or 6,500. But at some point, made the comment that, what's the probability when you're right here and you're at 6,600? What's the probability that the market's going to sell off another 300 or 400 points before it rallies 300 or 400 points? And that the equidistant probability is getting worse and worse for the bears. So overall, I can't say I'm surprised at all about this. And the hard part, whenever you see this, the odds are you're going to get a bounce, but it can go down further than you think. Right here, odds are you're going to get a bounce, maybe test the most recent lower high. But 4-bar micro channel, bulls tried twice to reverse up. And instead of getting the reversal back to 6,800, what happened? We got a second leg down. At this point, with the gap up and the strong rally today, again, just think about it from this perspective. Do you think the odds are the market is going to fall drastically below this bar? No. The reality is bulls buying it and buying more below the bar. They probably have a pretty high probability of getting, some sort of second leg. And that makes me think that, there's going to be buyers. I'm not so confident there's going to be buyers on the close. It's possible, maybe tomorrow we have another crazy big bull bar, but I'm going to think that's pretty low probability. More likely, the range of this bar is 2.5%. So it's big. It's not, huge, but it's definitely bigger than average. Rather than us, let's actually measure it in a quantifiable way. This is a Z-score indicator. It measures the range of the bars and compares it to the average and gives a standard deviation. It says, this bar is actually it's about 1.76 standard deviations away from the mean. So it's not incredibly big compared to the bars to the left. I suspect it'll have bad follow through, but it may not. I say that. When I say bad follow through, I suspect it will probably be a disappointing bar for the bulls. It may be a follow through bar, maybe something like this. But I think the reality is, even if we get a bear bar, it's probably going to find buyers. Let me see here. I think the reality is this bar is strong enough that you'll have bulls willing to buy and scale in, betting on a second leg. 5-minute chart. I'll talk about the monthly chart. Monthly chart, end of a month, end of a quarter. And, look what happened. We're testing this breakout point right here. And that's good. And that is good for That's good for the bears. But overall, the channel is fairly tight, and the rally up here is tight. That makes me think there's probably buyers in this general location. And therefore, bulls buying, scaling in, probably going to make money, which means we're probably going to 7,000. I think we're probably going to go to a new all-time high. But overall, maybe one leg, two, and then maybe a third leg up for a wedge. But at some point, we're going to fall below these lower highs. And I say these lower highs, I'm less confident we're going here and here for a long time. But every new, I keep saying lower high, these are higher lows, obviously. Every new higher low that we get increases the chances that we're going to fall below it. So is this higher low right here, potential, going to be the same as what happened in April of 2025? I doubt it. April 2025, we had the rally, pullback, and then a sudden, surge up. Market almost reached 5,000, came within 85 points of 5,000, and then surged to the upside. And what are the chances here? The market's pulling back. It's going to almost reach 6,000 and then surge to the upside. I think it probably will not happen. Even if we get a second leg up in a new all-time high, I think we're going to fall below this higher low. I wouldn't be surprised at all if we did. It'll be interesting to see what next month looks like. 5-minute chart. By the way, I will take a look at questions at the end of the review. 5-minute chart. We had a large gap up on the open. And I made the comment that I'm sure my opinion of today's open was pretty obvious based on what I've said over the past several trading days. This was, on a side note, I thought this was really interesting behavior. When's the last time you've seen 3 basically small pullback trend days or trending trading range days in a row? Obviously, it's pretty rare because you don't see a lot of strong bear bars, especially consecutive bear bars in a row on the daily chart. But the point behind it is, here, we gap down, rallied to the moving average, and then we form this tight bear channel all the way down. And then we got that crazy bull bar here. We gap down here, sideways, and then we got that, we just basically drifted sideways to down for pretty much the entire session. And then here, big gap up, big sell-off, formed a triangle, and then we sold off. So every one of these days, basically entered breakout mode. And that's a good point to make. Pretty common. And that's why I always say 80% chance that 80% of the time the market forms a trading range open. Here, trading range open. And therefore, if you're buying on the open, you're typically going to be in the wrong direction. Down here, 80% chance trading range open, 20% chance trend from the open. Here, yes, technically speaking, trend from the open bar 1, 20% chance was successful, but just look at the price action. Does this really look like a trend from the open? If we go here, are you saying, yeah, that's clearly a bear trend? This is this is about 24 bars, 25 bars. It's clearly not trending behavior at that point. And then we drifted sideways to down on that tight channel. But obviously, overall, good selling by the bears. And then same thing here. Even when you get a big sell-off, one of the reasons why this got such a deep pullback is look to the left. The market's gapping up and then selling off. And whenever you get a big gap up and a big sell-off, it's very much context dependent. The reason I say that is sometimes you get this. Big gap up, big sell-off, and you basically get an opening reversal and a large bull trend day. Why did this day happen? We'd have to look at the daily chart to get a better idea of it. Here, we had a tight trading range, and when the market gapped up, it was breaking above a bear bar, and then we sold off, testing the lows of it, and then rallied. So context was good for the bulls at that point. Okay, back to today. Today, we had a fairly large gap up, and it was reasonable to expect that. I forgot to talk about the Globex chart. I want to talk about the Globex on the open. We had some good price action last night. One of the things you have to realize about swing trading is, and there's always a debate. Al says beginners should swing trade. And then if you went to Orlando and you listen to Ali said that beginners should learn how to scalp. And they're both right in what they're saying. Now, what are they saying? Al is saying mathematically it's easier to swing trade than it is to scalp. Because mathematically, if you can be right 40% of the time and get at least twice your risk, you're going to have a profitable trader's equation as long as you can continue to do that. What Ali is saying is the reality is to be a proficient swing trader, if you want to be a good swing trader, you need to understand overall market behavior. In other words, you need to understand breakouts and second legs. And the whole point in me bringing that up is if you understood the overall context on the daily chart, then it actually made last night set up very interesting price action. So think about the logic. So we had a sell-off here and then a sell-off here. And what happened yesterday? Did we get another really big bar and a sign of a collapse? No, we got this doji. So when you see that doji bar, something I think about a lot, when you see this kind of a doji bar right here, are you thinking to yourself, wow, what an exceptionally strong bear trend? Or are you looking at that and thinking, hey, that's hesitation after a bear breakout with consecutive sell climaxes. Maybe tomorrow is going to go outside up. And then if you're aware of that, what do? If you go to a 15-minute chart, or you'll just say a 60-minute chart, keep it simple. Here's a 60-minute Globex chart. Doesn't break on us. Okay. So here was yesterday's. So here was yesterday. We had that rally, sell-off. Yesterday's close was right around here. So think about it. If you're a bull and you're looking to front run, taking a chance that the daily chart is going to form a large bull bar, what can you do? You could wait for the 60-minute chart to form an outside bar right here. You could buy the close of the outside bar, put your stop below it, and you're risking, what is that? Probably 70 points. And then where was the open today? Open of today was, right around here. So you got a reasonable, you got a decent entry price. Now, if you went to a 15-minute chart, you could buy right here at basically 63.98. Big bull bar closing on its high, put your stop below, taking a chance you're catching the low of the day on the daily chart. Remember the 60-minute chart? I want to prove a point here. That was 64.11 if you bought the close. If you bought the close of the 15-minute bar here, that was 63.98, so a little bit of a discount. If you were trading a 5-minute chart, you have to go way, way back. Let's see here. Yeah, should be right here. Because we went sideways, somewhat on the open first. But anyways, if you're trading a 5-minute chart, we had a bear trend line break to basically a lower low major trend reversal. We had a bull bar closing on its high. You could buy above the bull bar, putting your stop down here. You could buy the close of this bar right here at 63.80. So the point is, the lower the time frame, the more you can front run the eventual breakout that we had on the open. And why am I bringing that up? If we go back to the 60-minute chart, someone buying here, they're getting in. They're basically front running the early portion of a breakout. And this ended up happening. Now, the reason why I said that is the more you can understand about the higher time frame context and what's going on the daily chart, the more prepared, the more traders will be interested in front running a move. It's no different than a 5-minute chart. If you're trading a 5-minute chart, and let me go back to the right, go back to this bar. So if you're trading a 5-minute chart, and let's say, I have a good example here. Let's say let me find something I talked about. Something like this. if you think the market's near support, the moving average 54, you'll have some traders buying the close of 54 rather than waiting for the reversal up, anticipating that the market's probably not going to go a lot lower. But you get the point. The point is, the more you understand about the higher time frame context, the better position you can be in. Anyways, first bar of the day, bar 1, bull bar closing on its high. That's good for the bulls. Increases the odds that we're probably going to go at least a little bit higher. Right now, I think our market is probably going to try and reach the 6,500 round number. It's a logical magnet, and the market's close enough to it that the odds are we'll probably get there. And then 2, bull bar, doji. Not a great sell below 2. Probably buyers below in a second leg up. 3, it's a bear reversal bar closing on its low. Strong enough bar with bar 3 that it's a big enough bar. We may get a small second leg down, but you're still selling in the middle of the overall range, bottom third of the range. The market rallied on 1, sold off, rallied, and then rallied and reversed down on 3. That's not a great location to sell. Plus, the bear bar closing on its low after a large gap up, there might be more traders buying it. It's okay to get out of longs below the bar, and you can see what happened. Instead of falling below 3, more traders bought it, front running the buy. The bears selling obviously got trapped. That's a strong enough bar. We'll probably get some kind of second leg. 4 and 5 consecutive bull bars, good for the bulls, increase the odds of a second leg up. And then 6, we have another bull bar, but a tail below the bar. Now lowers the, it's good for the bulls, and it increases the odds that whatever reversal down we get is going to be minor. But the overlap and the market being far from the moving average, at some point we're probably going to pull back. And then 7, bear bar, probably buyers below scaling in lower, but a little bit dangerous. It's climactic, strong second leg up with big bars. Those big bars lower the probability that this will be a sustained small pullback bull trend. So right now, I think this is probably climactic behavior, and we're testing an important round number, 6,500, that we're probably going to stall here. And then decent bear bar on 8. Strong enough bar, probably sellers and around the midpoint of the bar, and at least a small second leg down. And then we got a pause on 9. Not a great buy above 9. Increases the odds that we're going to get a small second leg down after bar 8. However, the bears who sold the close of 8 disappointed with 9, they may look to buy back their shorts on the test of the second leg down. And then 10, outside up, good for the bulls. Probably going to go at least a little bit lower. Outside up, good for the bulls. Probably going to go at least a little bit higher and test up to the high of the day. But an outside bar after the bear breakout, the bear reversal and follow through. Bear reversal being 7, follow through 8, increases the risk of a second leg down. And then 9, outside up, that's good for the bulls. At this point, I suspect we're probably going to get a second leg up and test the high of the day. 12, follow through buying. Now we have 4 consecutive bull bars. Increases the odds that the first reversal down is going to be minor. And then 13, bear bar, not a great sell. Buyers below, more likely. And then we had a little bit of surprise with 14. 14, a little bit of a surprise. Probably buyers in this general location. But now we have a double top with bars 7 and 12. And we're trying to break below the neckline, the 11 low. That increases the risk that the market may sell off. 14, 15 consecutive bear bars increases the odds. We're going to go at least a little bit lower. And then 16, now we have 3 consecutive bear bars. Good for the bears. Probably going to get at least. It's good for the bears. Is it sell to close? It might be, but in general, I don't want to sell to close right at the moving average. That makes me think, that increases the risk that there's going to be more traders buying in this general location than selling. So really not ideal. And then 17, another bear bar breaking below the moving average. Now we have 4 consecutive bear bars closing on their lows. Good for the bears. Increase the odds that the first reversal up is going to be minor. But I suspect there's going to be buyers in this general location. And then 18, doji, bull bar, really not that great of a sell below the moving average. I suspect there's probably sellers. It's not a great sell. First reversal up might be minor, But we had such a strong rally here that I suspect bulls buying and scaling in are probably going to make money. And that means selling down here is really not ideal. 19, good follow through. Probably going to get a second leg up. Bears are trapped. 20 consecutive bull bars. Even though there's a tail on 20, bears want a second leg down. I think the rally 19 and 20 is strong enough that we'll probably get some kind of second leg up. And because of that, probably buyers around this general location. 21, bull bar closing on its high. Good for the bulls. We have a big bar 19, small bar 20, big bar 21. That makes me think a pullback is probably likely, plus the sell-off down to bar 17 was strong, and that increases the odds that the market is probably, going to get a pullback here. However, even if we do get a pullback, I suspect buyers not far below. 22, bear bar, probably buyers below, scaling in lower, but the pullback could be pretty deep. Then we had a high one by 23, but probably sellers above 24, second leg down. What about selling the close of 24? I would not. This is a location where the bears who sold down here, scaling in, are probably going to look to buy back their shorts, so probably buyers scaling in lower. 24, doji, second leg down. Not a great sell above, so I suspect buyers in this general location. And then 26, bull bar, but probably buyers around here, so not a great sell below the bar, not a great buy either. And therefore, but because of the context, I suspect buyers on the close or buyers on the low of the bar. 27, not a great sell, probably buyers. 28, same thing. Testing the 25 low, good for the bears. But some bears sold the 25 low and scaled in, and they're likely disappointed, and that makes me think buyers in this general location. 26, bull bar, second leg up after the rally, 25 low, 25 high. Bulls getting a second leg up right here. And then we tried to break the downside on 30, and then we reversed up on 31. 31, strong enough reversal bar. I suspect we'll probably get a second leg up and test of the 21 close. 32 consecutive bull bars, 31, 32, good for the bulls. Increases the odds that we're going to get some kind of second leg up. And then 33, doji, not a great sell below, probably buyers and at least a bounce and at a minimum a test of the 21 close. I still think we're probably going to get back to the high of the day, which is the 18 bar range, and break above it and test the 6,500 round number. We came within 3 or 4 points of it on bar 7, and I suspect we're going to reach it. 34, second leg up after 31, 32, good for the bulls, but not a great sell, probably buyers below. And then we broke to the upside on bar 35. 35, strong enough bull bar, probably a little bit climactic, so it may pull back, and that's why we got the bear bar 36. But as far as selling 36, I think it's probably low probability. The bears, you'll have some bears selling, taking a chance. It's a double top with 12, 36. They're hopeful that the market sells off and breaks below the neckline. 31 here, and then falls for a measured move. And then ultimately, they're hopeful that the market breaks below the 18 low and falls for a measured move down based on the overall range. High one buy 37, bear bar, not a great sell above the bar. It's a high one in a trading range in the upper third of the range, so it's bad for the bulls. But I think the rally is fairly tight and there's magnets above, and that lowers the probability. I think that lowers the probability for the bulls buying in this general location. And then we got that big surprise bar on 38. 38, enough of a surprise. Probably buy the close and going higher. 39, can you buy the close? You can, but it's a fairly big bar. And if you're going to buy it, it's better if you can use a wide stop and scale in. And when you see bar 40, you had some traders in you can call them market maker traders. They see a big bar like this and they think exhaustion, so they sell the close and they scale in on the way up. What are they going to do on the retest of the close of 38? You know they're going to buy. And therefore, there's bulls buying with limit orders on the way down and at the close of bar 38, betting on a bounce. But you have a high one buy of 40. You really want to buy above a high one after a large bull bar, and the high one has a lot of overlap, and it's a bear bar. 40 has a tail above the bar. 39 has a tail above the bar. That makes me think there's probably going to be more traders selling in the upper third of 40 rather than buying. And then we have a doji 41 in consecutive inside bars, so a triangle. Probably going to get a second leg up and test the 39 high, but we may have to go sideways for several bars. And then obviously bar 42, we formed a bull inside bar. Now we have 3 consecutive inside bars. So breakout mode with 3 consecutive inside bars following a strong breakout 38-39 where a second leg up is likely. I think it's reasonable to buy above 42. I certainly wouldn't sell above it, betting that the bulls may get an upside breakout. And then 43 bull bar closing above the highs of 40, bar 40 and 41. Good for the bulls. Probably going to go at least a little bit higher, but we may have to test the high of 42, the inside bar high. Why? Because a lot of times when you form a triangle and you break above the triangle, you often retest the breakout point. And that's what happened here. We sold off on bar 44, bear bar closing on its low, but not a great sell. Channel up's tight, magnets above, and I suspect there's probably more traders buying right here than selling. Bull bar 45 closing on its high, good for the bulls, probably going higher. And then 46 consecutive bull bars, 45, 46, good for the bulls. Makes me think a second leg up is likely. And then we form the bear bar 47. For the bears, they're hopeful it's a wedge with bar 40, 43, and then 46. Bear bar, not a great buy below the bar because of the wedge, but it's also not a great sell. The reality is, I think traders buying here and scaling in are going to make money. My concern with selling it is we have that obvious magnet not far above. We have an obvious magnet of the high of the day, the bar 39 high. And I don't think this is an adequate test. We had a rally, bulls buy, they scale in, expecting a test and a second leg up. And to me, I don't think this is a great lower high to be selling. It's not a credible major trend reversal. Follow through 48, good for the bears, but probably buyers in this general location. It's possible that 47, 48 are strong enough for a second leg down, and there might be sellers at the breakout point 47, but I suspect for the most part buyers, and you can see what happened. Traders who sold the breakout point 47 during 49, they got trapped with bar 49. 49 strong enough bar, I suspect, will probably go a little bit higher, but with the consecutive bear bars, 47, 48, not a great buy signal bar above 48, plus it's possible wedge. It increases the risk that we may have to get a second leg down below 48. And that's what happened with 50-50. Outside down, tail below the bar, not a great sell, probably buyers below it. And then we had the doji 51, not a great entry bar. It's a bear bar, minimum follow through, but it's an inside bar at the bottom of a trading range, just above the moving average after a strong bull breakout 38-39. I suspect buyers in that general location. 40 bull bar closing around the upper third of the bar with a tail above the bar. Not a great sell, not a great buy above the bar, but it's not a great sell below the bar either. And because of the overall context, I still think it's more bullish than bearish. And then doji 53, bear bar, or doji 53, probably buyers below scaling and lower. And then 54, we have a bear breakout, but close in the bottom, but with a tail below the bar right at the moving average, probably more traders buying it than selling it. And then we started to form that tight channel. Decent reversal up, 55, 56. Probably buyers on a pullback and a second leg up, 58. And then 59, the bear bar, not a great sell, probably buyers below it. And then we ended up just forming the tight channel. Whenever you form a tight channel like this, it can be really dangerous to start selling and scaling in. And that's because the tight channel forms, it's a micro channel on a higher time frame. And by the time you start selling and scaling in, and before you know it, your market's all the way up here. And if you sold here and you scaled in a little bit here, you scaled in a little bit here, maybe you got out break even here on 68, maybe you didn't. And then you're left the decision. Are you going to hold overnight, betting you can get out break even, or you're just going to take the loss? Remember, tight channels, they're micro channels. And so when you look at this, this right here, forming this right here. And when the bars are small and non-climactic, there's a less risk. When bars are small, especially when they're non-climactic bars, there's less risk of volatility contraction. What does that mean? When we think about it, if you measure the range of bars based on averages, that's why I like Z-score. Z-score is a measurement. It's the standard deviation of the bar, and it's a measurement of the range of the bar in relation to the past 20 bars. That's the lookback I had it set for, or have it set for, and it just measures the overall standard deviation. And therefore, if you have a bar that is 3 standard deviations larger than the past 20 bars, there's a much greater risk that the market is going to pull back. If you have a bar that is obviously 1 standard deviation greater than the past 20 bars, then there's an increased risk of the market getting an upside breakout. It's similar also in, when you see bars that all of a sudden become smaller. Big bars, volatility expansion, smaller bars, volatility contraction, and then you get a breakout. And then up here, I talked about that. It was getting dangerous for the bears. Excuse me. I was getting kind of tired at this hour from sitting here looking at the market. But anyways, what I was saying up here is, it gets dangerous for the bulls. The bulls buying, odds are you're going to get a pullback. This might be, this is kind of the best, this is the pullback you might get. And that's why I was warning that it may just go mostly sideways. For stop orders, you can buy above 1, probably okay to buy above 2. You can get out below 3, that's fine. I don't think, but obviously it didn't trigger. You can buy above 4, but I think 4 complicates things because it's a relatively large bar and we're getting a fairly large gap up on the open. That makes me think that we may end up forming a trading range and going mostly sideways here. And if where do you get out of shorts? You might get out below 7, probably okay. Definitely get out below 14, you can get out below 15, but if you do, you got to buy again above a bull bar, especially above 19. And then 19, do you get out below 24? You can, but I don't think you have to. We may get a small second leg down, but really not ideal. If you get out below 24 and 25 is a bull bar closing on its high, you probably have to get long again. The problem with a 4-bar micro channel or problem with a 4 or 5-bar micro channel down and then a 4 or 5-bar micro channel up is it's big down, big up, and it increases the chances that we may have to go sideways for several bars and form a triangle. And that's basically what happened right here. And then the market started to form a triangle. It broke above the triangle here, pulled back, and then we got the large second leg. Bulls, they can buy. Maybe they buy 31, maybe they buy 32 or above 33. Some will get out below 36. I don't think they have to. And then 36, it's a double top, lower high, major trend reversal. However, it's not a great signal bar. There's a tail below the bar, and it's following a bull bar closing on its high, 35. Traders who sell below 36, you can see what happened. The doji, their entry bar is small, and because of that, they know they're taking a low probability trade right at the moving average, just above it. A lot of those traders would bail out of the trade, and that's partially what led to the breakout on bar 38. And I mentioned that 36 is a little bit suspicious for the bears. It's forcing bears to sell just right below an obvious magnet, 6,500, and we're probably going to break out of the 18-bar range. So it's really more dangerous of a sell than it appears. Then a large bull bar, 38, closing on its high. Bulls can buy it. Where do they get out? Maybe they get out below 47. I don't think they have to. And at some point through here, they can just get out below a bear bar. But I think it's really tough to hold all through this. And if they're real fortunate, if they buy here and they hold up to here, they definitely get out below 78. It's just too late in the day. At that point, your risk is getting big. Better to get out and wait for tomorrow. Limit orders, lots of limit orders. Buyers in the bottom third of bar 1 and at the midpoint of the bar. Buyers below 5, buyers below 6. What about buying below 7? I would not buy below 7. I think it's better to buy below a bigger bull bar closing on its high, such as bar 6. That's probably better. Maybe sellers above 9, but after the rally and the gap up, I'd rather look to buy and scale in lower than sell. And then down here, I think it's really tough to buy, but probably buyers below the 4 low, buyers below the 1 low, especially if you can use a stop, a measured move down of this range, probably okay. And I thought sellers above 23, that's probably okay for a small second leg down. And then probably buyers below the 25 low, buyers below 30. I think buying the close or the low of 30 made sense. To me, it's very similar to 54. 30 is a good bar, and the bears really need 1 or 2 more follow-through bars. And therefore, when the bears need 1 or 2 follow-through bars, meaning the market's almost always in short, but it's not quite, you'll have traders betting that they won't get their 1 or 2 follow-through bars. Probably buyers below 32. I thought buyers below 37, that was okay. What about selling above 37, the high one? Well, the problem is, it's a small bar, so it's a volatility contraction bar, and that means it's a greater risk of a breakout mode bar. Selling above a big high one buy, selling above a doji like 23, being a relatively larger doji with climactic behavior and a strong sell-off to bar 17, that's actually a better high one buy to fade than something like this. Here, it's reasonable to expect the bears are going to get a couple of legs down and at least attempt to get down here. And the bulls, they had a big bar, 19, a little bit of a pause, and then a second leg up here, and then a bear bar closing on its low with a weak doji, so a weak high one, probably sellers above, and at least a small second leg down and a test. So it's a little bit different. Selling up here, it's reasonable to expect a couple of legs down and a test the bottom third of the range. And then, selling here, less reasonable. You're getting a bull breakout of a triangle, and you have a relatively weak, you have a high one buy that's relatively small. So it's really, not all that great of a high one to sell. I thought buyers in the bottom third of 39, buyers in the bottom third of 40, really buyers in the bottom third of any of this. I thought buyers below 43, probably okay. Sellers above 44, probably okay. Buyers below 49, scaling in lower. I thought buyers below 53, buyers below 50, during 54, probably okay. And really, if you're really determined, you can just buy all these lows, betting we're going to test up here. But I think it's tough to do. I mentioned over here, there's probably sellers in this area for a scalp, but this bar is too close to the moving average. There's probably buyers. You'll have some traders just buy at the market, betting on a bounce. And, obviously there's other limit orders. I thought realistically there's probably sellers above 39 scaling in. So it's probably okay, but you need a wide stop and the ability to scale in. And you got to be quick to manage the trade. So it's really not that ideal. Buy the close, sell the close. Not a lot of buy the close, sell the close. If you're really quick, maybe you sell the close 15, but even that, I wouldn't. I think it looks easy to sell 15. You think, yeah, consecutive bear bars, it's going lower. But you're right at the moving average. And from a risk-reward standpoint, it's really not that great. So none of this is technically buy the close, sell the close. And then, I thought maybe the only buy the close bar is bar 38. And, it'd have been really easy to miss it. Really big bar. And all of a sudden, if you missed the buy, it would just race up quickly. And it's easy to get frustrated by that. You look at bar 40, you look at this bar and you think it's 33 points. If I would have just traded my normal size and bought the close, I would have made 1 times the range of the bar and, had a great day. And that's true. You probably would have done well compared to the average range of the bar. But the reality is, who cares if you miss it? How many times do you get a bar that looks like that? Whenever you see a big bar, if it just feels uncomfortable and you don't want to buy it, it's moving too fast, just sit there and wait. You'll be fine. You basically had 1 bar that went immediately higher, and then you went sideways for the next 20, 30 bars. Let me take a look at questions. Is bar 14 a good buy? I don't know about 14. Buying below 14, it's not that. It's a little bit tricky. You're buying in the upper third of the range, and you can see what happened. You had traders buying below 14 here, and a lot of them that did when they saw 15 form follow through, they ended up, basically just selling, betting on a second leg down, selling out of their longs and looking to buy again later. What's my expectation tomorrow? I think tomorrow is probably going to be disappointing for the bulls. We have a almost a 3% rally on the day. We're probably not going to get another 3% rally. Question: how would you trade the parabolic bull bars around 8:40 Eastern time? I'm assuming you're talking about this right here, but how would you trade the parabolic bull bars around 8:40 EST last night? I guess you're talking about this. I kind of already talked about that. I talked about the fact that, for me, it's you buy here. It's kind of a few choices. If you're just watching the Globex market and you see basically a wedge bottom and you see a bull bar closing on its high with follow through, you either buy it here, you buy the follow through bar, buy the pullback, and you exit on a second leg up. And once the market starts to stall here, you exit. One of the things about Globex is pretty rare for the market to just immediately rally or immediately sell off and do that for a while. But if I was buying because of the daily chart or higher time frame, like the 60-minute chart, like I talked about here, we had a credible bottom, and we might get an early low of the day in the Globex market. If I was doing that, then I would just buy, stop below, and I'd hold for to basically see what we get overnight. And I will do that. Okay, do I always look at gaps as big bull bars and bear bars? Yes. By definition, a gap is a breakout. The way I think about it is a gap. What is a gap and what is a breakout? Well, it's an area where you have trapped traders, and therefore you have traders trapped into a losing position and traders trapped out of a winning position. And you think about the easy, obvious example is the middle of the day breakout. And you get a big bull bar like bar 50 or bar 38. Anyone who's sold anywhere in here, anybody that's sold and they're still short on this bar, they're in a pain trade. They're obviously on the wrong side of the market, and they're going to be forced to buy. They're going to be forced to buy back their shorts for a loss or on any pullback they can get. And any bull that is not long, they're going to be forced to buy or buy a pullback in order to get long. So breakouts, that's how I think about it. It's momentum. And momentum usually gets a second leg. And the more traders that are trapped, the more likely the second leg is going to happen. Okay, where do you put your stop if you buy the 55 close? Yeah, if you buy the 55 close, a couple choices. One, the more you're in a trading range, the more aware that you have to be that the market may fall below your stop and then go back up. You can buy the close at 55 here and put a stop one tick below the bar. That's fine. But the reality is that'd be selling right at the moving average. And for me, if I'm going to buy the 55 close and and bet on a rally, I'm probably going to put a stop, maybe 2 times the range of 54 down, and maybe 1 times the range. So not here, but put it somewhere around 55.20, and then kind of just manage accordingly. Okay, this is actually a good question, and it brings up what I talked about should beginners swing trade or scalp. Okay, so the question is, for beginners, it is recommended to take swing trades where you have a reward that is at least twice your risk. Looking at the end of the day 5-minute chart, it is easier to see why swing trades. It's easier to see the swing trades at the end of the day on a 5-minute chart. However, when you're trading live, this person's saying, watching live, the swing trades are very difficult to recognize. Yeah, it's very true. Hindsight's always 20/20. When you print out a chart, it's always going to look easy. It's going to look clear. You're going to say, well, of course, if you buy that bar, you get out here. But the problem is, one of the fallacies with the end of day chart is time is frozen. And if you think about it, think about your psychology. If you're looking at an end of day chart and trying to find the best trades of the day, what's really on the line? Time is frozen. You don't have to decide in this second. You can stare at it for an hour and make up your mind. You don't have anything financially on the line. There's no risk whatsoever. And you take that into account. How long do you really, if you think about it, how long do you have? Let me just ask this question in Discord. For a 5-minute bar to make a decision, how long do you have to make that decision? Anyone have an idea? So when you look at a chart and you're trading a 5-minute chart, how long do you have to make a decision? Andrew says 2 minutes. 10 seconds. Yeah, Andrew and Marcus, I think, are more right than some of the other comments. The reality is, if you have a strong understanding of the context, yes, you have more time to think because you're thinking more about the context. But the reality is, you never have. A lot of times, the bar will look completely different at the halfway point. So 50% of the formation of the bar can look completely different. So if you're trading a 5-minute chart, you may have 60 seconds, and that's to think about what the bar is forming. And then you may have 5 or 10 seconds when the bar is moving really fast, really make up your mind. So the point is, swing trading is always going to be difficult for the simple fact of what I talked about above. And the other reason why swing trading is difficult is context. I talked about it. In order to take a swing trade, you need the market to go much further, and you need it to behave in the direction of your swing for a longer period of time. If you're scalping for 1 or 2 bars, you don't really care so much about what the 60-minute chart or what the probability is on the higher time frames. And when you see a really big bar like this, it's breaking out of the triangle, you don't necessarily care about the higher time frame. You just buy and scalp out. If you're buying a pullback, if you're looking at this bear bar and you buy the bottom of the third, if you buy the bottom third of bar 40 during 41 and you're looking to scalp out, you don't care. You just scalp out. And so the reason why swing trading is so difficult is, from a math standpoint, it's easy to understand. But from a practical standpoint, the reason it's so difficult is that you really need to understand higher time frame context. It's kind of like yesterday. If you're looking at yesterday here, you sell bar 1 and you swing trade on the open after a large gap up on the open, odds are you're going to form a trading range. And it's really not all that ideal. Yes, you can sell and scalp out here, but the reality is, if you hold the trade forever, it's much more dangerous than it appears. And I'm not really answering your question, but the challenge is, and then you asked, let me answer the rest of the question. I know it's kind of it's a long question, so I'm trying to answer it in pieces. Basically the question is it better to just take reasonable trades and walk away and let the statistics play out over the long term? How does one gain confidence to recognize swing trades in live markets? Is it not just a matter of taking 100 trades and letting the data prove to you? Reading the How to Trade Price Action manual that beginners should target trying to make 4 points consistently daily and doing that. Okay. Yeah, obviously the whole point, the manual, that was many bars ago. I gotta wrap this question up, but the point is, as far as your swing trading, if you set it and forget it, you take a trade, you sell below bar 1 and you hold and you just wait for your target to get hit, you can go for twice your risk. But the reality is, waiting for your target to get hit and leaving the room and just waiting to see what happens, I think it's more difficult than it appears, because the reality is, a lot of swing trades don't really go your way. In other words, 40% of the time you take swing trades, you're going to catch a big move. 60% of the time, you're going to make a little, lose a little. So I hope that makes sense. All right, I've got to wrap this up. So I appreciate everyone listening. And overall, to answer your question, I think it's better to try and just go for twice your risk. Okay, thanks everyone, and I have to go.